Welcome back, everyone. The topic of this video is the 3 things that every single options trader should know before trading. And this isn't just something that's for beginners. I know of a lot of options traders who've been trading for months, some for years, who either don't understand these concepts or haven't heard of them at all. So we're going to get into that today. I'm going to break them all down. Who am I? For those of you who are joining us for the first time, my name is Peter Tarr. I'm a former licensed stock professional. That's a licensed stock trader, and also a licensed options and derivatives specialist. It's a mouthful. And I've been in the capital markets for nearly 2 decades at this point. So that started in 2004, 2005, I became licensed, and then through 2006 received additional specializations. So we want to talk about options trading, and that's something that I focus on my Twitter feed, which is Profits Taken, and of course it's profitstaken.com for my private insiders group. But let's get started and look at what these 3 things are. So number 1, I want to talk about part of what you're seeing in front of you, and this is all going to be inside the options chain. So every single one of you will have access to this information if you have a brokerage account, and it's nothing that you shouldn't be able to find on your own. And what I'm using in front of you, for those who are curious, this is IBKR, that's Interactive Brokers. It's the brokers that I prefer, and I think it's absolutely worth a look. You can see that in the description below. And what we're looking at here is an options chain. So there's some data here. The first thing I want to start with, so number 1, the Greeks as well as IV. So we're going to talk about that. What do I mean by the Greeks? Am I talking about the culture, the civilization? Of course not. So you see terms like delta, theta, there's gamma, there's vega, there's all sorts of different terms. Which ones do you focus in on? Do you need to know all of them? Well, always, the more you know, the better. But what's most important to understand, we're going to go over the 3. It's delta, theta, and IV. And that is particular if you're trading intraday and you're just trying to get to the basics so that you have a proper understanding of what's going to happen and how it's going to work. So delta, what we see here, tells you how much your options contract should move when there's a $1 move on the underlying. So we're looking at Tesla here. I pulled up Tesla because highly traded in terms of options, and most people are interested in Tesla. It's a very popular security to trade, lots of volatility. So what that means is, let's just take this as an example. So this would mean that if the Tesla stock moves up $1, this contract that you buy, and this is the bid, this is the ask, should move up 44 cents, right? So a $1 move on Tesla, let's say it goes from 205 to 206, will bring the contract price up by 44 cents. Now there's more to that, but you need to understand that because that gives you a general idea of what to expect in terms of movement on your contract. What I want to add to that is, regardless of what you read here, keep in mind, you should always be paying attention to your options contracts. Never just make assumptions. Manage your trade, particularly if you're day trading and it's an intraday trade. If you're doing something like setting it where you have stop losses in place and profit taking, okay, that's fine. But in terms of being able to manage your trade effectively, be watching it, because this is not an exact number and we're going to explain why. This gives you an idea of how much you should see a change here for $1. So if you're targeting a, let's say, 20% move, right? And we'll just go based on the bid. So that's going to be about $1.18, right? It's going to take about $3, well, just under $3 for you to get that if we go strictly on the delta. So that's the delta. And it's important because it sets your expectation and lets you know how to project forward, right? So if you're trading something that doesn't move very much, let's say you get a 37-cent delta on something, and it's a stock, let's say something like Uber. You're not expecting Uber to move too much. Maybe it moves $1 in the day. Well, you can expect that when you're setting your profit taking and your stop losses. You might not want to say, hey, I'm targeting a 20% plus return. You might want to tighten that number because the likelihood of getting a 20% plus return will require a $2 move, and that's not so common on Uber. Of course, if you know something else, perhaps you have an advantage there, but you have to understand the projections in accordance with the stock and the underlying and what you can expect. So that's the delta. That's what it means. This just tells you how much this option contract that you buy should move based on a $1 movement. And of course, the same is true on puts, right? So this is the call side, this is puts, how much it should go down, right? How much you'll appreciate should the price go down. Because on calls, we're looking for a move up, and on puts, we're looking for a move down, right? So what else is important here? Well, and these are the weekly strikes. So you could just see the We're looking at the expiration date weekly, April 6th. That's 4 days this week. Why is it 4 days? Well, we're upcoming. It's going to be Holy Thursday and then Good Friday, and the markets are closed on Good Friday. So now, theta is so critically important, and it gets underestimated all the time. Theta tells you how much, we also call it time decay, right? It tells you how much the value of your options contract will erode, how much it will decay, how much it will go down, depreciate, whatever adjective you'd like to use, in approximately 1 day, right? So why is it going down at all? Because we're getting closer to expiration, and there's something called intrinsic and extrinsic premium. So meaning intrinsic is just the inherent value of your contract. Extrinsic is the premium that you're paying to speculate, right? So how much you are out of the money. Your out of the money payment is what gets deteriorated over time. If you just want the simple way of thinking about this without the intrinsic, extrinsic talk and the premium and what you're going to have towards the end, just know this. This is about how much your contract will depreciate day over day. And ultimately, anything that's not in the money will end up at zero come expiry, meaning on the last day. In this case, that's April 6th, right? Normally that's a Friday. This is even more important for those of you who want to trade things like the SPY or the QQQ, because those allow for zero DTE trading, meaning you can pick up a contract on Monday that expires on Monday. Most stocks that you see, you're going to see weekly expirations, which is typically Friday unless there's a holiday. But you could pick things up that expire same day, meaning this theta decay is telling you, hey, by the end of the day, anything that's not in the money is going to go to zero. And it's not such that you just see, okay, end of the day, we're down 73 cents. It doesn't work that way. It's not all in one shot, so you're not safe. What's happening is as you get closer to rolling over, and this is, to the next day, as you get closer to rolling over, you're going to see that theta effect decay your premium. So remember, it doesn't just work instantly, and it doesn't work on a smooth line. This gives you a general idea of how much your contract will decay. The short story is, the closer you are to expiration, the more the value of your contract is going to erode over time. So you want that move, you want that intraday move, but remember, even if something is moving in your direction, let's say that, okay, you bought calls and it's moving up slowly, so you're appreciating slowly, but then you're also depreciating slowly with theta. So you don't want something to take too long. If it takes too long, theta will actually have more of an effect. Again, that's just time decay. That's the loss of time towards the close the premium. Will have more of an effect than delta. And the last item, I have a separate video on this, is IV, implied volatility. So implied volatility isn't here, and implied volatility is very difficult to gauge with exact precision. But why is it important? And this is just on the Greeks, and then we're going to move on to the next two items that are extremely important to know. Implied volatility, I highly suggest everybody watch the video. I'm going to put it up. I'm going to put the video up. I'll put a link to it in the top right corner. It essentially can change the options contract from 10, 20, 30%. I've seen it change the value by hundreds of percentage points, particularly when you look back at like the GME and the meme stocks that skyrocketed. What does that mean? What is the simple explanation for IV or implied volatility? Meaning, if you have something that's moving very quickly, people start to pile on and pay a higher premium. Let's say Tesla price is skyrocketing, right? It opens at $205 and it shoots up, and in the first 2 minutes it goes 206, 207, 208, 209. We're at 212. What's going to happen is people are just going to start paying higher premiums. That means they're going to start bidding higher and saying, I'll pay more for that contract, because everybody's going to want in on calls. Tesla's taking off, something major happened, I will pay more and more and more, right? So the premium starts shooting up higher than it is, even unrelated to the underlying. People are just willing to pay more because they're saying, look, I'll take that risk, it's fine. So you're going to end up paying a premium higher than you would have if it was moving slowly, right? Now, here's what can happen though. If the momentum dies on Tesla, even if it's still moving up, you could lose money, because this could go from $5.90 to say $7, right? And everything's taking off, and then it just slows down and starts going sideways. Well, the hype isn't there. People aren't having the rabid bidding anymore. And in fact, what you purchased, even though you're still moving up or now you're going sideways, will fall in value. So it's very important to understand. I highly recommend. I actually gave a intraday example of this. We saw it happen live, and then I was able to cover it. It was a video on Roblox, I believe. Very interesting one. If you don't understand this, it's so critical, because oftentimes we make moves at what people pick as support and resistance zones, these often see rapid moves because there's heavy volume, there's heavy supply and demand, price starts shooting up. If you don't understand implied volatility, it's because a lot of the nonsense gurus don't really talk about it, or they understand the very basics like IV crush after earnings. Make sure you understand all of it. So delta, theta, and IV, all important because they can change what you're seeing here. And you don't want to just look at this and start feeling like, what's happening? How come this isn't going the way that I thought it would? You need to understand why your price is changing. Otherwise, you get caught like a deer in headlights and you don't make the right moves. You panic. You start thinking, oh, the markets are rigged. None of this works. Nothing makes sense. You don't want to put yourself in that position. Number two, the second thing that every options trader should understand is the importance and significance of spreads. Here's the bid and the ask, right? So let's take an example here of a bid and an ask. 78-cent bid, right? This is the 232.5 strikes. And an 85-cent ask. That means the spread, and this is just straightforward. Don't ever be intimidated by all the lingo. A lot of people like to use the financial jargon and lingo to impress you. That should never be the point. If you're a straight shooter and you understand what you're saying, you should actually try to simplify it, not position things to exalt yourself and make yourself seem like an authority. I think the greatest minds are those that can explain complex topics in a simple way. So bid and ask, what's a spread? It's just the difference, right? 7-cent difference. 78 to 85, 7-cent difference. Why is that significant? Well, when you're placing your orders, you have to be conscious of wide spreads, right? Not a wide spread here, 1 cent. As a percentage, right? So if you look at this, the spread here is less than 1%, 104 to 105. How about here? We're looking at approximately 10%. So why is that a big deal? How does it impact your day-to-day trading? Okay, well, you have a choice when you're entering your order. How would you like to submit your order? You've probably seen this. You can choose a price, right? You can set a bid, which I'm sure you've seen, or you can accept the ask. And all that means is if you set a bid, you say, hey, this is what I'm willing to pay for it. And the person who's selling, they have an asking price. They might meet your price. They might meet you somewhere in the middle. They might not, right? Or you can do what's called market. If you've ever seen the button that says place a market order, you'll see this with every broker. That just means you buy at whatever someone's selling at. So, and I don't like market orders. So let's talk about the significance here. Why is this such a big deal? Okay, well, let's take this example, right? This example, this 232.5 calls. So if we have a bid of 78 cents and ask of 85 cents, well, let's say that you do something like you come in and you get really aggressive and you hit the ask, meaning you place the order and say, I will pay 85 cents, right? You're willing to pay what the selling party is asking for. You just paid 85 cents, which is going to be $85 a contract, okay? Let's say that's you buy 10 contracts. It doesn't really matter. You're in for $850, commissions aside. Why is that important? Because you need to recognize you just put yourself in a negative situation. You are in negatively. Why? Because you just paid 85 cents, or you're in for $850, right? And the most someone's willing to pay for that is 78. So the value of your contract based on the market bid is now 78. You're down 10% just to start this trade, right? Because remember, what you can get, the value of whatever you have, and this just goes for anything in life, is only what someone's willing to pay for it. No one cares that you just paid 85 cents. Good for you. You're down 10% because the best you can get on the market right now is 78. That is the highest bid. This is a difficult way to start a trade because you're back 10%. So let's say that you're saying, okay, well, my stop loss is going to be 10%. Well, you're already at your stop loss. Congratulations. You just paid commission and you got stopped out of a trade, particularly if you've automated it. Or now you're going to have to start expanding and justifying why you're going to go past your stop loss. Or let's say you told yourself, okay, I have a maximum stop loss of 15%. Okay, I'm going to lose 15% on this trade and I want to target 20-25% upside. I want to make 20-25% profit. Okay, well, you're now 5% away. You're almost there. You're 2/3 of the way there to your stop loss, right? Because you're down 10% and you're a ways away from things going your way. Plus, you have theta working against you. So you better get a move. You better get a move soon. And you have very little space to trace back. So I don't like the idea of starting behind in a trade 10% because typically I like to set 10% as my stop loss, meaning if it hits minus 10%, I exit the trade or somewhere near there, right? Maybe 10, 12, and I've said you can expand out close to 15 if you have high conviction in a trade. But this is a really bad way to start. Now, if I start at 104, right? Or let's say I purchase at 105 and the bid is 104, that's okay. I'm down about minus 1%. That's fine. I'm not as bothered. I have a lot of space to go. If it pulls back 10% or 12, whatever it is, okay, I stop out. And if it moves, I move right into the positives. I'm sitting near neutral. So getting the positive move that I planned at whatever it is that you're using, and I rail against this idea of just using lines on a page and some furu nonsense magical level. There's so much more to options trading and so much more to stock trading. And again, you can look at the description if you want to learn from me directly or follow me on my feed. This isn't as bad, right? Even if you hit the ask at 105, okay, you're back 1%. Your trade has space to work out. If it's going to go against you, it's got to move down your 10% or whatever the case. And if it starts going your way, okay, you're in a better position. But you mind the spreads, right? If there's a really big spread, you're in all sorts of trouble, right? So if, let's say this is 78 and this is 90, you really can't hit the ask there because you're so far back to start. Again, always keep in mind whatever the bid is, that's what the contract's going to be worth. So when you're deciding what you want to pay for it, just remember, bid is generally, right? There could be bids in between there, but generally, that's what it's worth. So if something's worth $3.20 and a person's asking $4, you need to really calculate and think about it. Do you want to pay $4? Because you better be right. And it better be aggressive and a strong move, even just to get you back to break even, right? So in this case, another way to say it is you need a 10% move just to get back to break even, right? That's difficult. That's the deck being stacked against you. So the importance of spreads, the difference between the bid and the ask, and knowing that the best you can get is what the bid is. Now, how do you circumvent that? You can come in at the bid, or if you want to be a little bit more aggressive, you can come in above it, right? So over here, it doesn't mean that you have to hit the ask. It doesn't mean that you have to put in at the bid. You could bid 79 cents and see if you get a fill, right? The higher you go, the more aggressive you're being. So if you say 80 cents, you're being more aggressive. The more you are willing to pay on this wide spread, the more of a risk you're taking. Like if you hit 85 cents, you're down about 10%. So maybe you go try 79. You don't get a fill. You move it up to 80 or 81. Or maybe you go, a lot of people like to go in the middle. But even on that idea of going in the middle, if it's a 30% spread, even in the middle, you're down 15 to start. So be very conscious of the spreads, because if you're targeting a move, it already destroys, a big part of your idea. To start behind 12% when your stop loss is 15, you're almost there. So we get the idea of spreads. Then finally, and this ties right in, is something that gets ignored so frequently, and I think a lot of times furus and Twitter scammers like to do this intentionally: volume and open interest. So let's just talk about this. This is liquidity, right? High liquidity on something like Tesla. You can see it starts to come down around here, right? Very high liquidity. But let's take something else. Let's take something like Uber. Well, not Uber, but Uber, right? And let's take a look and see how Uber fills out. So data just populating. We're after hours here, so. Okay, what you see with Uber is the volume is very different, right? You see like 3, 2, 56 options traded, 738. This is really low volume, right? So what does that mean? Why is that important? You can even take a look, and we can go across the board. There's a lot of stocks where there's low volume, low open interest. Why is low volume dangerous? Okay, well, it's like I said with the bid and the ask. You can only sell. There's a very dangerous idea of like, oh, I bought this and I can sell it. Have you ever bought something that you thought you'd sell and then you couldn't find someone to buy it? Okay. But you look online somewhere and it's like, oh, well, this is worth such and such dollars. This is how much I paid for it. Yeah. Well, you probably learned really quickly. No one cares. And I speak in a harsh way because money is very important. I'd rather be honest and tell you guys straight the way it works. Better you hear a video that makes the thought slightly uncomfortable in your mind than you take a trade and you lose a lot of money, right? Be prepared. And I care about people having the right information and being prepared. You can only get what someone will pay you for something. And if there's no interest, there's no volume, people aren't buying something, then you're not going to be able to sell. So let's take a look at this, right? The volume was 1. So let's say you bought 10 of these contracts, right? And you bought them at, I don't know, 360. And now the ask is 385. You can get 370. You're thinking, okay, I'll take a little bit of a small profit here. I'm going to sell it. Okay, well, guess what? You could try to sell it even at 370. You've got one. Now you have a bid size that's pretty good there, but there's been very little activity. So you have to know your sizing and the volume, right? Is the bid size substantial? Like here, small bid size. Is there going to be someone on the other side willing to buy, right? This just represents the current bid and the current ask. But that doesn't mean it'll be enough to purchase your contracts. What if you have 10 contracts and there's only someone out there bidding for one? Well, this is the way the market works. It's an open market. It's real people. If there's no interest in buying, then your price is worthless, right? It's kind of like having a piece of art and saying, oh, this was appraised at $10,000. Okay, cool. Who wants to buy it? Oh, well, I'm definitely going to get $10,000. Cool. Did you find a seller? No. No one wants to buy it? No, I haven't found one, but it's definitely worth $10,000. No, it's not. It's worth whatever somebody pays you for it. And if there's no buyer, you're going to hang on to it. And the problem with options contracts it's moving towards expiration. And then you get yourself in a sideways situation. What if the stock starts moving against you? And now to unload it, you start having to move down and finding a bid size at a lower bid. So here you are thinking, okay, well, I'm going to hit I'll just hit the bid at 274. I'll be able to sell all my contracts. Nope. There's no volume there. So now maybe you're thinking that you bought at, I don't know, 250 and you're going to make a profit here at 274. You may have to move down to $2 or $1.90 and take a loss. And then you're going to walk away really bitter thinking, what the heck just happened? I had this trade idea. It was a winning trade idea. I looked at the spreads. I made sure everything was working properly. I went to sell and I ended up selling at market and there just wasn't anything in the market. I kept on moving my bid down because nobody was there. So be conscious when you're buying these, right? And it's all relative to your position sizing. So if you see there's adequate volume, let's just say something like, well, it's not, we don't have very good volume. The best volume here would be on the 271s. But if you see there's adequate volume for your sizing, okay. If you have a big position size, like you buy 100 contracts, then you probably don't want to see something where the bid size is maybe 30 and the overall volume on the day is 400, right? Because now you've got a big position and you're looking to match 25% or 20% of what we've seen all day on the volume. As you try to sell pieces of that off, it's very likely that you're going to have to sell for less and less and less. So the way to avoid that is if you're not confident and you're not able to locate it, you want to move to more liquid options. So what do I mean by liquid options? Well, let's go right back to Tesla, right? When we pull up Tesla, very different story on all the liquidity because this is one of the most hyper liquid stocks out there. It's one of the most traded. Now we look at it, we see 20,000, 1,000, 6,000, 18,000 traded today. You see really big trades. You see big bid sizes, right? So this will probably fill what most people have because you start talking about tens of thousands of dollars in options contracts. So you want to be conscious of liquidity. So let's recap. You want to know the Greeks. You want to know delta, right? That's how much the options contract should change for a $1 underlying move, meaning if the stock goes up or down $1, how much your contract's going to change, how much money you're going to make based on that. So you can project how much money you expect to make, right? And that's important because if you look at a stock where you say the stock's only going to move 10 cents on the day or usually only moves 30 cents, you may decide that's not viable because my contract's not going to do anything and I'll lose out on the next one. Theta, it's going to erode the value of my contract. And then of course you need to understand implied volatility, so make sure you take a look at that. Then we talked about the significance of spreads, right? You don't want to be in on a bad spread because it puts you behind to start off. You start off without an edge. And the whole idea is you want an edge when you're trading. And then we just talked about liquidity. These are the three things that people rush into trades. And one of the scams out there with a lot of furus is they pick low liquidity options, right? So they're much more easy to manipulate. So just be careful. So if you see low liquidity, just be conscious, know what that means, and they're much more easy to manipulate. You've heard of people with low float scams on stocks where they only look for stocks that have low float because it can be manipulated by low volume. Just be careful with that. But it also could just mean that you don't have an opportunity to liquidate. We call it liquidity. We call volume and interest and bid sizes, all that sort of thing, liquidity, right? Like remember the painting example. It's not liquid because you don't have a market for it. If everybody out there is trying to buy a painting, or let's say you were selling an iPhone, whatever the newest one, 14 is, it's probably pretty liquid, right? You can find a buyer. If you go on eBay or somewhere else, or you list it locally, you could probably find a buyer because a lot of people want to buy iPhones. And so it's the same idea. You need to have a buyer in order to realize any profits, in order to be able to exit your position. So that was it. Delta, theta, IV, the significance of spreads, and how critical liquidity is. Guys, if you want to learn more, you want to learn from me directly, it's profitstaken.com. You can check that in the description below. And if you're curious about this brokerage software, this is different. This is not Thinkorswim. I've explained many times that I like IBKR. I like IBKR Pro in specific. This is IBKR Pro. I think it's worth a look. Take a look in the description. I have a link to it. You can check it out. Decide for yourself. All right, everyone. I hope this is really helpful. Feel free to look at all of my videos, and we will be back with more in the future.